You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hello, everyone, and welcome to December. We're just that much closer to ending this crazy year that is 2020. So thank you so much for joining us today. We're going to be talking about how to deal with stock market turbulence. I think there's going to be no shortage of turbulence in the future, and I think the goal here is not just to deal with the turbulence. Some people don't mind flying. Some people don't give two thoughts about it. Some people hate flying, and sometimes managing or dealing with your retirement portfolio, investment portfolio, can be a lot like flying. So we're going to talk a little bit about that today and how to deal with the volatility that inevitably continues to make its way through the market over and over and over again. But before we get started, as always, a few housekeeping items. If this is your first time listening, then the Cash Podcast is produced weekly. As stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is always for everyone who's listening or watching today to learn a little bit more about each and every episode so that you become more successful, wealthier, happier, and more educated than you were when you first started listening or watching today. So please come back often, hit that subscribe button. We're both on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós, as well as Instagram at Financial Surgeon. We're on Facebook at facebook.com/Libertas Wealth. And last but not least, all visuals, links, charts, and other resources are always available on our website at libertaswealth.com in the education section. We won't be having all that. Well, we're going to have visuals for people watching, but if you're listening on iTunes today, you don't need them. If you want to go back and check them out, you can always do that, or just email me and request them, and I'll send them to you. But we're not going to be posting the slides. Excuse me. We're not going to be posting the slides on the website this time because honestly, there's no charts, there's no tables. We're just going to hang out and talk today. So let's go ahead and jump into it. I always like to start with a quote for those of you who've been watching or listening for any period of time. Today's quote, again, kind of going back to volatility, ups and downs in the market. Today, what we're going to talk about is how to deal with the market kind of freaking people out and doing the things that it sometimes does. And the first quote, or the only quote we have today, is by Benjamin Graham, and it goes like this: "Letting losses run is the most serious mistake made by most investors." And the reason why that quote's really interesting, and we could turn this into a whole podcast by itself, is because what most investors do as humans, we're emotional beings. We've got this prefrontal cortex that causes us to be so much different from a decision-making standpoint than most animals, and as a result, we're just horrible investors. So again, we could turn this into a whole podcast about letting losses run, selling winners, but that's what humans do most of the time, and that's what this quote's all about. Is Benjamin Graham was basically saying that what humans tend to do is, if they have a portfolio, and there's 4 stocks in the portfolio, just to keep things simple, and 2 of those stocks are, say, up 10% and 15%, and then the other 2 stocks are down 5% and 10%. Even though the losers aren't losing as much, what a human will tend to do is they'll tend to sell those winners and take the profits off the table, and then either A, they'll hold on to those losers because they want those losers to come back. It's like painful to see them down, so it's like, well, I'm going to hope they come back, so I'm just going to hold on to those losers. Or worse, they'll add money to those losers and average down, putting good money after bad, which is almost never a good idea. The only time it's a good idea is when you get lucky, which obviously we have no control over that. So anyway, so let's get into the meat of the conversation today. First, before I kind of get started, I want to talk about strategic versus tactical, and what the differences are in strategies, because this is one of the things we can do to combat volatility. Is sometimes the markets go down really fast and come back really fast. And the perfect example is 2020 was the craziest year that I would say that I've ever seen in my career, but really that the market has ever seen since the 1800s, since the S&P started, the Dow, the NASDAQ. There's never been a crazier, more fast-moving year in the stock market than we've seen in 2020. The market went down into bear market territory, down more than 35% in 22 days. And then it went up 35% in 29 days. So it was just so fast and so volatile. I can't even imagine what that might feel like if we turn that analogy into a plane. That it'd be more than just a little bit of turbulence. Let's put it that way. You might feel like you're gonna, like the plane's going down for a quick second, and then all of a sudden you come lifting back up into the air in a way that plants you to your seat. But anyhow, so one of the things we can do to help with volatility is diversify our strategies. There's two types of strategies that you can generally use in the market. One is called strategic, or I like to call it static. So just remember, when you're thinking about strategic, to avoid all the minutia and the confusion that comes along with the jargon in this industry, just remember strategic starts with an S, and so does static. And what that basically means is that while the investments inside the portfolio will change, and what we want to do is stay with, I always say, stay with the playoff teams. We want to stay invested, not if our portfolio was of all the teams in the NFL, let's just say, we wouldn't want to be invested in every team. We just want to be invested in the playoff teams. Now, sometimes teams will stay in the playoffs for 2, 3, 4, 5, 6 years. They just keep coming back because they're strong teams. And those are the teams, metaphorically speaking, again, if they were investments, that we would want to stay invested in. Now, the teams like my beloved Cleveland Browns, who are, I think, the 8-2 or 8-3, I'm sorry, for the first time since I was a sophomore in high school, and that was a long time ago. That's a team that we would have been avoiding. In other words, an investment we would have been avoiding for years, for almost 3 decades. So again, using an analogy here, where investments are like the playoffs in NFL or the NFL itself, we'd want to be avoiding the Cleveland Browns and the Detroit Lions and these investments, so to speak, that just don't perform well. And as teams make the playoffs and other teams leave the playoffs, we'd want to be selling those laggards, rotating away from weakness and into strength. But that's how strategic works. But what makes it static is that it never gets out of the market. It always stays allocated to a certain target, whether that's 100% stocks, 70-30, 60-40, or say 35 or 40-60. The next type of strategy would be trend following. Trend following is tactical. So again, same kind of memory tool here, where tactical starts with a T, and so does trend following. And trend following obviously is different. We've got tactical strategies are more intermediate term. We're doing this staying with the playoff team concept as well. Asset class rotation, sector rotation, industry group rotation. Again, we want to, if the playoff teams are one set of teams this year, we want to stay invested in those teams. If 1 or 2 teams next year start to weaken, and again, we're talking investments here. If one of those investments starts to weaken and it doesn't, and another team is showing a better record or ranking, so to speak, and making its way into the playoff picture, then we want to rotate out of the weakness and into the strength. But what really makes trend following strategies different is the extra layer of risk management that inherently makes them more conservative, which is created by exiting the stock market when severe storms appear on the horizon, metaphorically speaking. So when the market starts to look really unhealthy, and when we start to see very high risk reward situations arrive, then what we want to do is we want to exit the market. And when we do that, it's not like we're just, I'm not just looking at, in our tactical models, I'm not just looking at, one indicator or 3 indicators, even in saying, okay, well, these 3 indicators are risk off, so we're just selling everything. Every investment we own, or every football team in the NFL, has its own trend. In the case of the tactical models in September, we owned some bonds, we owned Zoom, and we owned Dollar General, and that was it for almost the entire month of September before getting heavily back invested in the market in October. But this whole fall has been nothing but whipsaws, and that's where tactical strategies struggle, and we'll talk about that in a second here. But let's talk about strategic in a little bit more detail. So strategic, similarly speaking, is also, again, it's also using the asset class, sector rotation, industry group rotation, but it's a little bit longer term. Strategic allocations are for maybe a portion of your portfolio. If you want a portion of your portfolio to stay in the market all the time, it's like I said, longer term. I think younger clients definitely want at least a good chunk of their money probably invested in a strategic portfolio, but it still stays invested in the playoff teams. We're still using that rotation, but you don't get the whipsaws that you do with tactical portfolio management when those severe weather shows up on the horizon, because if it shows up really quick, like we have a quick downpour and then it's gone, a tactical portfolio is going to get out of the market to avoid, getting hit by lightning or hit by a tornado, whereas the strategic models are just going to stay in the market, weather the storm, and if it comes and goes quickly, then, we didn't get out. In hindsight, when it's all said and done, we go, okay, that was a good idea, we didn't get out of the market. However, if the market does go through a normal, say, 16 to 18 month market crash, or something like we saw during the dot-com bubble, which was a 2-year market crash, it takes some really serious mental strength to get through a market like that in strategic static models, because it feels like the sky's falling, time goes so slow over such a long period of time, to the point where you're like, oh my God, when's my portfolio ever going to come back? So if you invested $1 million in the year 2000 between the first crash and the second crash during the Great Recession, so the mortgage crisis, you didn't break even until 2013 April. So it was a 13-year period where you did nothing but lose money, and that would have been extremely frustrating. So I think that the whole point here is that for some people, we just got off the phone with a client yesterday, and they've got a nice sized portfolio. They've been great savers their whole lives. They had a medical practice and sold it, and he and his wife are all about tactical. They realize that sometimes it's going to underperform. They realize that sometimes there's going to be times when the tactical models get out of the market and we sell, and then we have to pay higher prices to get back in. But that's the cost in a tactical model. When the market moves extremely fast, that's the cost of avoiding the big, huge, life-changing crashes. So, for instance, in March, when the market was crashing during the Corona crash, if you have a portfolio that's strategic static model, then in the middle of March, you could be looking at your statement, logging in online, and you could see your portfolio down 1/3. You could see 30, 35, 40% even of your portfolio value down. And that would be extremely difficult psychologically. Again, going back to the whole human discussion and the emotional discussion, how difficult that is to handle those losses. So, yes, it came back, but we didn't know that it came back so quickly until obviously it was already over. So going to kind of close out this whole concept of tactical, strategic, and the two different types of main strategies that we can implement, it's for some people, tactical is what makes them comfortable. It's the right strategy for their personality. It's the right strategy for them emotionally, and it's a good way for them, and that's how they can stick to their financial plan and stick to their future goals, because without a plan in place, a true written comprehensive financial plan, we're just investing in hoping we have enough. But if we have a plan and we've invested the portfolio according to that plan, using appropriate risk measures, the appropriate portfolio models, then for some people, tactical's fine, and that's all they want to do. Other people, we had a new client who just came on board a month ago, and they're in their late 40s, which is kind of closing on the brink of somebody who might want to be more tactical. But their opinion was that, I'm not going to open my statements. I'm not going to look at this stuff. Let's talk, once a year until it's time to maybe start getting more tactical as I get close to retirement. And that's the decision they make. So we put all of their money into strategic models that stay in the market all the time. And there's going to be times when their portfolio is going to be down a lot. Probably a lot more than most people would be comfortable with in the interim, and we don't know how long it'll take for the market to come back. But eventually, again, what we can do is we can kind of invest or diversify between these two different types of strategies, putting some in tactical, some in strategic, or in the case of these two polar opposites that I just discussed, these case studies, real life case studies, I should say, all of it into tactical or all of it into strategic. But what do you do about anxiety? Because some people, there's nothing wrong with it. We're all different. We're all different people. We all have different, histories when it comes to investing. We all have just different predispositions from the standpoint of who we are, behaviorally speaking. So what happens if I'm saying, what happens if you're too conservative? And I hate to use that phrase, too conservative, because it insinuates that you're too conservative to be in the market. Let's just say, but that's possible. So how do you deal with that anxiety? How do you deal with maybe if you're stressed out and if you constantly log into your account online and you're constantly worried about what's going to happen to my money if it's down this week or if it's down this month? Oh my God, what am I going to do? I'm not making fun of that. I want to be clear. There are several people who feel this way, and the stock market, or just the markets in general. This could be the bond market, the commodities market, whatever. You can be a bond portfolio. The bond market's been a nightmare this year. It's gone down in the beginning of the year. It screamed northward through, I believe it was March 7th. Then it went down through September, and then went sideways since the summer, and it's still pretty much going sideways. So even bonds have been difficult to have your money invested in. So what do you do with this anxiety? And my first recommendation, and this is extremely difficult for anyone, it almost goes against the very fiber of who they are. But my first recommendation is to not look at your statements. Worse yet, don't log in online. Don't go logging into your account online every day. We have a piece of software that gives us the ability to track who logs into their accounts of our clients and how often. And it's insane sometimes what we see. And again, I apologize for using the word insane, because I'm not making fun of anyone here, and I'm not judging anyone. But it's when I think of the psychology of investing, there is a direct correlation between how often you pay attention to your money and how likely you are to give up your strategy, to completely abandon your financial plan, sell everything you own, and just sit in cash and I guess in a fetal position and freak out, and it's not healthy. And so especially for people who are extremely anxious conservatives and that the market kind of stresses them out, the best thing to do is to stop logging in and to not look at your statements and to just kind of step back and let it go and give it time. And I know, again, that's extremely difficult, and it requires solid trust and confidence in whoever your chosen financial professional is that you work with. That trust and confidence is crucial to your success. So, unless you're a do-it-yourself investor who's been managing your own money, which is totally fine. I always say that, people who manage their own money, it's entirely possible to do that. Not only to manage your own portfolio, but manage your own financial planning, retirement planning, estate planning, and so on, tax planning. But you have to have two things. A, you have to have the interest, and then B, you have to have the time. And if you don't have the interest, you're not going to spend time on it. But even if you do have interest and you think it's fun, many people just don't have the time, period. They just don't have they're too busy with work and things of that nature. So unless you're a do-it-yourselfer, if you don't fully trust and have the utmost confidence in your portfolio manager, the person who's managing your money, you either need to take steps to strengthen that relationship, ask questions, get the answers you need to help get that high level of trust, or start interviewing others to find someone else who you feel you can trust at that high of a level. Because until you have that trust, it's just going to, I think you're going to continue to have this anxiety that is counterproductive in terms of you reaching your own retirement planning goals, whether that be retiring when you'd like to quit working, or making sure you never run out of money in retirement. So both are crucial. So what if you're still too conservative? What if you say, I still can't handle not looking at my statements? Here's an analogy. And in fact, if you're listening, you know exactly who you are, but I was speaking to a client yesterday who was the inspiration for this podcast, and this is the analogy I just kind of came up with on the fly. So for those people who are afraid of flying, they don't like to fly. We have some clients, a few who will not get on an airplane, period, no matter what. And if you are afraid of flying, chances are you're going to take some sort of anti-anxiety med or something that puts you to sleep. So let's just say you have to fly on vacation. You've decided to take a European vacation. Obviously not now during COVID, but you know what I'm saying. So let's just say we want to go to Europe, we want to go to Italy, we want to go to Greece, France, England, wherever. And we have to fly unless you're a strong swimmer or you want to take weeks to take a boat overseas. So you've got to take, I don't say you have to take something, but you decide that in order to handle this flight and the anxiety of flying because you're terrified of getting on a plane, you take an anti-anxiety drug and something that just puts you to sleep. Well, here's the analogy. Do you just not travel anymore that requires a plane to get there? No, some people I know that's what they do. They literally will probably miss out on seeing the world because they just won't get on a plane, period. And for those people, using the metaphor and my analogy here with the stock market is, for these people when it comes to investing, maybe they just shouldn't be in the stock market. Maybe they should be invested in things that are guaranteed, whether that be, investments that have some risk, like variable annuities, but they have guaranteed minimum income benefits. So they have some sort of guarantee that gets you in the market and gives you that inflation protection, but also guarantees your income from now throughout the rest of your life. There are pros and cons. Cost. There is lack of inflation protection in some cases with annuities, but it's better if you need to have inflation protection, which most people do, unless you're filthy rich. If you need to have some sort of way to keep up with it's inflation protection. That's what I'm saying. But if you need to keep up with the rising cost of healthcare and everything else we buy in this world, then you probably need to get something more than what the bond market or the CD market is paying us right now, which is a pittance on our money. So most people who are afraid of flying, they just take the medication, they go to sleep, and when they show up at their destination, they wake up safe and sound, and everything's fine. And I guess that's my analogy here when it comes to the your retirement savings and your investment portfolio. Again, it's extremely difficult for some to turn a blind eye to their monthly statements and to not log into their accounts. But if it creates anxiety, understand that by you logging in, if you're already anxious as it is, by logging into your accounts, by looking at your statements, that you're creating more anxiety. It's a negative feedback loop that just causes a cycle that makes things worse, and it's not good for you. It's not good. It's not going to help you stick to your plan. It's not going to help you. And the plan's long term, obviously. You're not, unless you're somebody who's going to spend the money in the next 2 years, all of it. Which you shouldn't be invested in the market anyway, by the way, if you're going to spend your money in the next couple of years. But if you've got 10, 15, 20 years to live, then you probably should be invested in some sort of diversified portfolio, whether that be a really, really conservative portfolio, some tactical, some strategic, all tactical, and then just to kind of let it go and then trust your financial professional, have the confidence in them to do their job. And then when you want to meet and go over things because you're worried, use those meetings as a way to build that trust and to build that confidence. Because if you just don't look, you're going to be much better off long term, and you're going to be more likely to arrive at your financial destination safe and sound. All right, so moving on here, the number one reason investors fail. So the number one reason that investors' retirement plans fail is because they abandon their financial plan. But why did they abandon the plan? Why don't they stick to it? And the answer to that is they focus too much on the short-term market volatility, the ups and downs in the short term, which causes them to freak out and abandon the investment strategy. So, buying low and selling high makes perfect sense until you factor in the emotional impact of market events like the coronavirus, like stimulus bills, like SARS that we saw before, like the Brexit. I could show you a chart that has so many market events and news events and headlines on it that you wouldn't be able to read them because we'd have to make the font so small because there are so many headlines that come out on a week-to-week, month-to-month basis that there wouldn't be room to put them on one page. But just like buy low, sell high makes perfect sense until you factor in the emotional impact of market events. As Mike Tyson once said, everyone has a plan until you get punched in the face. So, unlike boxers who get in the ring and it's just them and their opponent and they have to defend themselves and do their best to win the fight, as investors, if we're investing on our own, that's exactly what it's like. It's like being in a boxing ring, and as soon as you get punched in the face, you better have a plan. Otherwise, you're going to get pummeled, and you're going to lose the fight. And metaphorically speaking, you're going to lose your retirement fight. So in the case of hiring an investment professional, which is most people do, most people don't manage their own retirement money, especially if they have a lot of money. They don't manage it all on their own. But everyone has a plan until they get punched in the face. Well, if you're sitting from the sidelines and you're watching your financial professional do the fighting for you, then understand that they've been trained, they've been seasoned, they've been through lots of fights. Not to toot my own horn, but I've now been through 3 of the biggest market crashes in U.S. history in my career, and when these things happen, they don't really concern me. I don't know. I live, breathe, and eat this stuff all day long, so it's not really all that concerning. But again, that doesn't matter if you don't trust and have confidence in your financial professional. So again, going back to what I was saying earlier, you have to build that trust. Whenever we get a new client, I always like telling this one story about this client that met with us. This is probably back in 2009 or 2010, and they came in for, normally we have 3 meetings. A discovery meeting, it's 2 hours long, ask a bunch of questions, education meeting, financial planning meeting, and then we typically maybe do a Q&A meeting if they have more questions, and then that's it. Then let's off to the races. Let's onboard and start working together, start doing strategy review meetings periodically and so on. But in this client's case, they wanted to meet with me for the Q&A meeting, so we did the discovery, education, financial planning meeting with recommendations, Q&A, and then I think we met another 3 or 4 times. So it was a long process. And what's interesting is as soon as they started working with us, they were still super anxious. I don't want to say they didn't trust me, but they were just not the most trusting in the world in general, and they were just very anxious when it came to their money. And they, as a result, wanted to come in and meet every quarter, which is not common. We have several clients who come in twice a year to see us and have review meetings, but this person wanted to come in every quarter, and that's what happened. She wanted to come in every quarter, and she did for the first probably year and a half. And then after a while, it became twice a year, then it was once a year, and now we can barely get her to come in a decade later just to come in for an annual review meeting. So she built that trust because she had to get over her own demons when it came to her past, the behavioral psychology that she feels when it comes to money and investing and retirement planning. So again, you have to build that trust, build that confidence in any way that makes the most sense for you. And I think one of the best ways to do that is just to spend more time with the financial professional that you work with, whoever it is. Spend more time with them, do more reviews, phone calls, Zoom meetings, things of that nature. Ask questions, get answers. And if it still isn't working, if you still don't have that confidence, then either A, they're not the right person for you, and that would include anybody who's my client listening to this, by the way, either they're not the right person for you, or it might not even be that they're not the right professional for you. It might just be that as much as you've tried, maybe the stock market isn't for you. And I hate to say that, because for most people need to be in the market, again, just to keep with a portion of their money to keep up with inflation over the long term. So if not now, then maybe later, right? So if it's not right now, if you can't get over the anxiety now, then maybe later, because these are tough times. I mean, I don't have to tell anybody we're living in a pandemic, and there are so many reasons why the market might go, down 10% in 2 days. So it's crazy times. We don't even know how the market has really been affected. The economy has been affected by all these shutdowns, these restaurants, bars, uniform stores, dry cleaning. There's a lot of companies, small businesses that have been really, really hurt here. We don't know quite yet, I think, how that's affected the economy. But I do believe that the American economy will prevail, and in the end, everything will end up just fine. But back to the point of the conversation. Excuse me. Back to the conversation again. So here's some more reasons why people fail. When I say people, why investors fail, clients fail at their financial planning. And it's back to the human emotions again. You may have heard this before, but the pain of loss is greater than the joy of winning. And what I mean by that is, when it comes to investing, is that if you make 20% in any given year, it might feel great, but it probably hurts worse to lose 20%. in the vast majority of people's minds. Even if you're up 5%, being down 1% is probably more painful than being than it is joyful to be up 5. So this is important, I think, to keep in mind. Another thing is fear and greed. So fear of losing money when investments aren't performing well, or fear of missing out when the market's going up but you're not keeping pace. And that's a huge mistake that I think a lot of investors make. Not the majority, but a lot. Greed, believing that your investments should beat the market. So that goes right along with being, the FOMO, fear of missing out when the market's going up but you're not keeping pace. If you're not invested in 100% stocks, then you shouldn't even be comparing your portfolio to the stock market anyway. And even if you are comparing your portfolio to the stock market and you've hired someone to help you, you have to pay them a fee, and that fee is going to create a drag. And every once in a while, I don't hear this often, but maybe once every 2 years or so I'd say this has happened 10 or 12 times in my career, I'll have somebody come in, new prospective client who is interviewing us, and they'll say, what's your fee? And then they'll say, my goal, I'll say, what are you looking for in terms of rate of return? What do you think would be reasonable in terms of a long-term rate of return on your money? And I'm asking that purposely because I'm trying to make sure that we have a good fit. Because there are people who we just simply aren't a good fit for these very reasons. This podcast that we're discussing, all these things about human emotion, and they might say something like, well, I just want to beat the market net after fees. So in other words, after your fee's over, I want to win and beat the market. Now here's what's interesting about that. First of all, the vast majority of professional money managers, from financial advisors to hedge fund managers to portfolio managers, do not consistently beat the market. Not on a quarterly basis, and not even on an annual basis. When I look at my record, I've only beaten the market probably almost 40% of the time going back my entire career. So to beat the market is extremely difficult on a consistent basis, especially net after fees. So anybody who's just looking to just make money and beat the market, they probably don't have the best goals in mind, and they're not going to be a good fit for us, because our goal is to, based on the portfolio you're invested in, let's just say you're in a balanced model with 60% or 65% stock target and a 35% bond target, we're never going to, I don't want to say we're never going to beat the market. We'll beat the market when the market's going down, but we're never going to beat the market when it's going up, or at least that'd be extremely difficult because we have so much invested in bonds, which creates a drag on performance. Unless, of course, the bond market goes nuts, northward that is, in a good way, and then the stock market goes down. I suppose that's possible too. So there's a higher probability in conservative portfolios of beating the market when it goes down, which is the whole purpose for having a more conservative portfolio, is for smoothing out that ride. But believing that your investments should beat the market all the time, it's a losing battle, and you're going to look long and hard and you're not going to find it. And even if you invest your money on your own one day, or if you already have, then you already know this. You already know how difficult that is, because we always joke. We have a joke in this industry behind the scenes that says, the best portfolio manager in the country is sometimes the person who puts together, or the team of people who put together the S&P 500 each year. So an argument might be, well, why don't I just put myself in the S&P 500 and just leave it there? Well, yeah. I mean, if you're young, if you don't look at your statements, if market volatility doesn't bother you, if when your portfolio is down 50% that you're not going to sell anything, if you're never going to take any money out of your portfolio, if you're never going to supplement your Social Security or pension money with something from your portfolio, then yeah, you don't have anything to worry about. But that's unfortunately not the case for most people. Most people really struggle during market crashes. I've seen it happen in my career a couple times now, 3 times, and I think most people struggle, especially when they retire and they start taking money out of their portfolio on a monthly basis. To see the market going down and taking money out of their portfolio is extremely anxiety provoking. And I also think that most people don't want to be in a portfolio invested 100% in stocks and to go through the ebbs and flows. And that's not even the right word, ebbs and flows. It's more like the tornadoes and blue skies on the beach that the market is, and you just don't know what you're going to get on any given day or any given year. So anyway, I'm rambling here, so I'll shut up and move on. But my point here in saying, believing the investment should beat the market is not a good belief to have, because that does, even the best investors in the world, Warren Buffett, Peter Lynch, Benjamin Graham, who I mentioned a quote earlier, have ranked in the bottom quartile of portfolio managers at some point, if not multiple points in their career. If you're ever interested or nerdy enough and you want to do yourself a favor, go pull up a chart of Berkshire Hathaway, either your Berk B or Berk A, either the A or B share class, doesn't make a difference, and go back in time and look and see how Warren Buffett's performance has been during both the good times and the bad times. And I think you'll be shocked to find out that he hasn't done as good as the headlines make you think he does. So anyway, moving on. And then the last thing here with human emotions, reasons for failure, again with greed, wanting all the upside in the market without any of the pain, and that's just unrealistic and impossible. You can't. Everybody wants this, and I get it, but you can't have all the upside in the market without experiencing some sort of turbulence and volatility. It goes back to our airplane analogy. So how do you deal with turbulence? The solution's kind of tricky. Again, it goes back to trust and confidence. Diversifying your strategies perhaps might make sense. So instead of being all tactical or all strategic, kind of doing a combination of the two. That way you have something that's working all the time. Because when the market is moving quickly and tactical isn't working, strategic static models do extremely well. Now, when the market's grinding lower and we're in a normal market crash and the market's down over a course of 16, 18, 24 months and doesn't come back, then strategic static models are going to struggle, but tactical is likely going to perform a lot better. So having something that's working in your portfolio all the time is a good strategy. Relying on the rules of each strategy is another solution or way to deal with turbulence. So instead of your reaction to the news, radio, or 80-page silly articles that you get on the internet that make you, read for an hour and then you go out have to watch a video that you can't fast forward through or rewind, and then you have to watch the video and then other market headlines. Rely on the rules of the strategy. Have the trust and confidence in the person you're working with, and then just give it time. Give those cookies time to bake, and then never ever try to anticipate. Don't let your emotions win. Again, humans are terrible investors because of our emotions. So I always like to say in our tactical models, we're not trend predictors, we're trend followers. There's no such thing as predicting the trend. So I'm going to end with a quote today, and then just share one or two more things that we do to help our clients reduce risk, to deal with market volatility and that turbulence. But the last quote here is when John D. Rockefeller was asked what he thought the stock market was going to do, he replied, "I believe the market's going to fluctuate." And I think that's a pretty good answer, a political one, but an honest one, and one that's very true. So lastly, before I close, one of the things that we do for our clients is a risk assessment that turns their behavioral psychology and how they deal with market turbulence into a speed limit. And for some people, that speed limit goes from 1 to 99. If you're a 1 mile an hour investor, you have no place in the stock market. Even if you need to be in the market to help with inflation, if you're a 1, 2, 10 mile an hour investor, I just don't know that you'll ever be able to deal with volatility. So I really think the best thing to do to avoid running out of money in retirement due to inflation is just to put money in a high interest bearing money market account, buy some CDs, maybe buy some bonds, collect the interest, hold them till maturity. And if it's not enough money or you can't keep up with inflation, then you're just going to have to adjust your lifestyle. You're going to have to spend less money, do less, travel less, whatever the case is. But over the long term, you just won't be able to afford to keep up. Or as I like to say, you'll go broke safely if you're not too careful. So for some clients, really, really low scores, like we see occasionally 25, 35 mile an hour speed limits. And these people are the more conservative people that should be in a conservative model, whether that's all tactical, all strategic, or a combination of the two. Usually it's a combination of the two, but sometimes it's all of either. It just depends on the person in question and kind of what type of strategy speaks to them. Then at the other end of the spectrum, you've got your 99-mile-an-hour investors. These are people who typically have to wear a flame retardant suit because their car, the way they drive, they're going a quarter mile in less than 10 seconds. We do have some clients that are in the 90s, which always surprises me. But I think that investors are always aggressive when the market's going up, and then they're conservative when it's going down. That's just my opinion based on almost 20 years of observation and observing human behavior in my office and our practice. But if you're in a 98, 95, 90 mile an hour driver of your metaphorical retirement portfolio, then maybe you need to be in a portfolio that's primarily invested in stocks over time. And this could be the case for people who either they're younger, they've got lots of time, but even younger people, most younger people that we talk to, they don't typically invest this aggressively. They still do worry about how the short-term volatility and turbulence will affect their minds and their ability to stick with their plan. But even so, you might be a younger investor and really aggressive, or you might be an older investor, you might be even retired, but you've just done such a great job of selling your business. That's funny. I was going to say but you might have sold your business, and you might have done a great job of saving your whole life to where you've got a portion of your money that's going to be used more conservatively to keep up with inflation, pay your bills. Maybe we've got a bucket that's paying all your fixed expenses, and then we've got this other bucket that's again moving along in a Ferrari, down the Autobahn. So this risk assessment is part of the way that we help to mitigate risk with our clients and help them deal with the psychology of the markets. And then the other thing we do, and this is way more important than a risk assessment, the risk assessment tells me what the client wants, but their financial plan, their retirement plan that we put together, a written plan, tells me what they need. And what we want to do is we want to give our clients what they need, not what they want. Now, sometimes when what they want and what they need conflict, it just requires more education, more time, more counseling, and eventually, again, we build that trust over time because the market can be a real pain. And the way our process works is this. We have a 2-hour discovery meeting first, where we ask every question you could possibly imagine, plus some questions you never imagined we would ask. So that's to get all the information we need so we can put together that financial plan on the third meeting. The second meeting we go over we call the education meeting. I go over how we're structured as a fiduciary. We go over that risk assessment that turns how you behaviorally think about investing into a speed limit. We go over some investments 101. We go over our tactical models and our strategic models. Depending on how much information you want, we go into more or less detail depending on the person we're speaking to. But the second meeting is all about educating you. So on the first meeting, while we're asking questions and you're doing all the talking, the second meeting, we're just teaching and educating and answering questions. The third meeting is the financial planning meeting, and that's where we take everything we've learned about either the business or the family in question or the individual in question. That's where we take everything we've learned about them in the first 2 meetings, and we put together a full-blown comprehensive financial plan, looking at fixed expenses now and in the future. We're looking at one-time expenses for things like whether you want to help out with the cost of a wedding, help out with the cost of college, how often you're going to take vacations, big, huge, vacations that might involve flights overseas perhaps, whether you're going to do that once a year, twice a year, maybe once every other year, how much it's going to cost, how often you're going to take road trips throughout the year and what that's going to cost, how often you're going to purchase vehicles net after trade-in and what that cost is going to be. So we take all these things, we throw them into the financial plan, we extrapolate it out into the future, adjust it for inflation, and then we want to find out 2 things. A, for those of us who are not retired yet but looking to retire, are we on track to making work optional someday, and ideally at the point at which you'd like to have the choice to quit working? If we are, great. If we're not, then we have a bunch of recommendations for how to make adjustments, whether that's retiring later, spending less, or saving more. Ideally, we want to save more so we can quit when we want, or even earlier perhaps. And then secondly, the other piece is more important, both for people who are not retired yet as well as our retired clients, and that's making sure that we never run out of money in retirement. So making sure our money lasts longer than we do. After those 3 meetings, typically, we have what we call a mutual commitment meeting, paperwork meeting. This is where we just sign the paperwork to get everybody on board. Then we have a 45-day meeting to make sure all introductions are being made to people like CPAs, attorneys, because a lot of the recommendations we make in that financial planning meeting include, big picture advice for things like estate planning, tax planning, insurance. And that insurance can be long-term care, it can be life insurance related, and so on. Again, we're a fiduciary, so we don't sell insurance. We recommend the correct amounts we feel our clients need, and then we refer them out to other professionals that we trust. Unless, of course, you have somebody that you already work with, then we will simply work with them. But the point is here to make sure that we have your whole financial house in order. And if you haven't seen it yet, one of the last things we do once a client hires us and we start working together is to build what's called a My Promise Kit. And you can go to our website and you can watch the video on our website about the My Promise program, which is brand new this year. The coronavirus actually, and the time we had where we weren't meeting with clients gave us the ability to build this initiative, which is 3 years in the making. So feel free to check that out. But that's all for today. This was a little bit longer than usual, so I apologize for the length. If you have any questions or you'd like to learn more, feel free to go over to our website at libertaswealth.com. Lots of research, education, articles, videos, podcasts. Old podcasts are there, as well as on iTunes and YouTube. You can follow me on Twitter at Adam Koós. Facebook.com/LibertasWealth is our Facebook page. Again, I'm on Instagram at Financial Surgeon. But that's it for today's show. Please feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, remember that you never have to be a client to ask a question. So if you'd like to set up an introduction call or a Zoom meeting just to kind of fire some questions our way, just head over to our website. And you can schedule something in our calendar on our contact page. There's a link there that gives you the ability to give access to our calendar. If you'd rather just email us, you can shoot an email over at info@libertaswealth.com. If you just have some questions, we'll fire it back to you. Usually within 24 hours usually isn't an issue. And as I always say, there are thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Please subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get not only these updates for these podcasts, but other screencasts, videos, articles that we write directly sent to your email inbox. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.